There is a conversation happening right now in the financial world that most people will never be invited into, not because they lack intelligence, not because they were born into the wrong family, not because the system is entirely rigged against them, but because nobody ever handed them the right lens through which to see money. And without that lens, everything looks the same. A paycheck feels like progress, a raise feels like success, a new car feels like reward. And the cycle continues quietly and visibly year after year, decade after decade, until one morning a person wakes up at 53 years old and realizes that their financial life looks almost identical to the way it looked at 27. That is not an accident. That is a design. And today we are going to examine that design carefully, honestly, and without flinching. Because somewhere inside the philosophy of one of the most studied investors in human history, there are ideas so simple, so patient, and so deeply countercultural that most people dismiss them on contact. They want something faster, something louder, something that feels like action. But the secret was never about action. The secret was always about thinking. And that is precisely where this begins. Most people have been taught to relate to money through emotion. They feel excited when they earn it. They feel anxious when they spend it. They feel envious when others have more of it. They feel shame when they fall behind. Every financial decision made from inside those emotions is a compromised decision, not because emotion is wrong, but because emotion is short-sighted. Emotion responds to the present moment. And wealth, real wealth, is constructed entirely in the future. Think about what happens during a market downturn. The news turns dark. Numbers on a screen begin falling. People who considered themselves investors 6 months ago are now selling everything they own, desperate to stop the bleeding. They are making permanent decisions based on temporary information, and the cost of that reaction is not just financial, it is generational. The employee mindset, and this is not a criticism of anyone who works a job, is built around one central idea: trade your time for money, show up, perform, receive payment. It is a fair exchange on the surface, but underneath it sits a dangerous assumption, which is that your time is the primary asset you have to offer the world. The moment you accept that, you have placed a ceiling above your own head, because time is finite. And any system built on finite inputs can only produce finite outputs. This is not about quitting your job tomorrow. This is about understanding the invisible walls of the system you are living inside. Because the first step to building wealth is seeing clearly, and clarity requires distance from the emotion, distance from the urgency, and distance from the cultural noise that tells you to spend today and worry about tomorrow later. Lifestyle inflation is one of the quietest destroyers of wealth that exists. You get a raise and your rent gets more expensive. You get promoted and your car gets newer. You earn more and somehow you also spend more, and the gap between income and investment never actually widens. People confuse the appearance of wealth with the construction of it. Appearing wealthy and becoming wealthy are two entirely different projects. One requires spending, the other requires restraint. And in a world that profits enormously from your spending, restraint is practically a form of rebellion. Short-term thinking is the other mechanism that keeps people locked in place. The human brain is wired to respond to immediate rewards and immediate threats. This served us well in a world where survival was a daily concern. It does not serve us well in a world where the most important financial decisions we make will not bear fruit for 15 or 20 years. Patience is not passive. Patience is an active, deliberate, disciplined choice that most people are not willing to make. And that unwillingness is not weakness. It is simply the result of never having been shown what patience applied to capital actually produces over time. That is the conversation we are entering now. Warren Buffett did not build one of the greatest investing records in history through genius alone. He built it through something far more teachable, far more accessible, and far more uncomfortable than genius. He built it through the relentless, almost obsessive application of a few simple principles over a very long period of time. The first of those principles is this: understand what you are buying before you buy it. This sounds obvious and is not practiced. Most people who participate in financial markets are not buying businesses, they are buying symbols. They are buying tickers, trends, headlines, and tips from people they have never met. They are participating in a game they do not fully understand, driven by a fear of missing out that is carefully engineered to keep them moving too fast to think clearly. Buffett's philosophy, inspired by the teachings of Benjamin Graham, was to look at a share of stock not as a number on a screen, but as a fractional ownership of a real business with real earnings, real assets, real competitive advantages, and real long-term prospects. When you think about it that way, the question changes entirely. You are no longer asking whether the price will go up tomorrow. You are asking whether this business will be more valuable in 10 years than it is today. That is a different question, and it demands a different kind of thinking. It demands that you study, that you read, that you understand the nature of the business, the durability of its competitive position, the quality of its leadership, and the trajectory of its industry. It demands that you develop genuine conviction, because without conviction, the first moment the price drops, fear will overwhelm your logic, and you will sell at exactly the wrong time. This is why the secret is not a stock tip. It is not a particular asset class. It is not a formula or a system or a shortcut. The secret is a way of thinking, and most employees, most people living inside the urgency of bills and paychecks and responsibilities never have the space or the guidance to develop that way of thinking until now. The first lesson hidden inside this philosophy is what we might call the discipline of doing nothing. This is extraordinarily difficult for people who equate activity with progress. In investing, in wealth building, in the management of capital, doing nothing is often the most sophisticated action available. When prices are falling, doing nothing requires tremendous emotional control. When a new opportunity appears exciting and urge, doing nothing requires intellectual confidence. Buffett has held positions in companies for decades, not years. Decades. The compounding that has occurred inside those long-term holdings is not magic. It is the mathematical result of time combined with quality and patience. The investor who buys a genuinely great business at a fair price and holds it for 20 years will, in most cases, outperform the investor who trades constantly, reacts to every news cycle, and pays taxes and fees on every transaction. But holding for 20 years requires something most people never develop: a relationship with uncertainty that does not produce panic. The markets will fall. They always have. They will recover. They always have. The investor who understands this as a historical fact, not just an intellectual idea, is the investor who can hold through the fear and emerge on the other side of it with wealth intact and compounding forward. The second lesson is the concept of the margin of safety. This idea, developed by Benjamin Graham and deeply internalized by Buffett, is essentially this: never pay more for something than it is worth, and ideally pay less. This requires you to have an estimate of intrinsic value, which requires you to understand the business, which brings us back to the first principle. These ideas are not independent. They form a system, and like any system, they only work when all the components are present. In practical life, the margin of safety principle extends far beyond investing. It is a philosophy of protection, of conservatism, of building buffers between yourself and catastrophe. It means not borrowing more than you can safely repay. It means not making financial decisions that require everything to go perfectly in order to survive. It means structuring your financial life in a way that allows you to absorb setbacks without being destroyed by them. Most people structure their financial lives in the opposite way: maximum leverage, minimum reserve, full exposure to every risk, one unexpected event away from genuine crisis. The margin of safety is not pessimism, it is wisdom. It is the acknowledgement that the world is uncertain, and that the wise response to uncertainty is not to pretend it does not exist, but to build your life in a way that can withstand it. The third lesson concerns the nature of competitive advantage. In business, this is called a moat, a durable, defensible advantage that allows a company to maintain its pricing power, its market share, and its profitability over time in the face of competition. Understanding moats changed the way Buffett invested. He moved away from buying cheap businesses with mediocre prospects and toward buying excellent businesses at fair prices. The insight was that a truly great business, with a genuine and durable competitive advantage, would compound in value over time in ways that a mediocre business bought cheaply never could. This lesson applies to your personal financial life in a profound way. What is your moat? What makes you valuable in the marketplace in a way that is difficult to replicate? What skills, what knowledge, what judgment do you possess that will remain valuable as the world changes? Because your earning power is an asset. It is, for most people in the early stages of their financial journey, their most significant asset. And like any asset, it can be developed, protected, and compounded. Investing in your own knowledge, your own skills, your own capacity to generate income and make better decisions is one of the highest return investments available to any human being. Read more, think more deeply, develop genuine expertise, build a reputation that precedes you. These are the moats of personal finance. The fourth lesson is about the relationship between fear and opportunity. Markets are driven not only by rational analysis, but by human psychology, and human psychology is subject to extremes. When fear is widespread, prices fall below intrinsic value. When greed is widespread, prices rise above it. The discipline of moving against the emotional current of the crowd, buying when others are afraid and being cautious when others are euphoric. C is one of the most consistently profitable behaviors in the history of investing, but it is almost impossibly difficult without the internal stability that comes from deep knowledge and long-term conviction. This is why the preparation matters so much. You cannot act rationally in a moment of crisis if you have not done the thinking before the crisis arrived. The investor who has studied a business carefully, who understands its value, who has conviction in its long-term prospects, can look at a falling price with curiosity rather than terror. That curiosity, that calm intelligence in the face of chaos, is what separates those who build wealth from those who destroy it in moments of collective panic. The fifth lesson is perhaps the most important, and it is the one most completely at odds with modern financial culture. Wealth is not built through the right moment. Wealth is built through consistent behavior over an unreasonably long period of time. The power of compounding is not complicated, but its true scope is almost incomprehensible to the human mind because we are not wired to think in exponential terms. We think linearly. We imagine growth as a straight line rising at a gentle angle, but compounding is not a straight line. It is a curve that begins almost flat and then over time begins to accelerate in ways that defy intuition. A person who begins investing a disciplined amount of money consistently at the age of 25 and continues for 40 years will arrive at a financial position that seems almost miraculous compared to the person who waited until 45 to begin. Not because the second person is less intelligent or less hardworking, but because time is the most powerful variable in the compounding equation, and it is the one variable that cannot be purchased once it has been lost. This is the secret that most employees will never hear, not because it is hidden, not because it is complicated, but because it requires them to begin before the results are visible. It requires faith in a process whose rewards are decades away, and in a world of instant information and instant gratification, that kind of faith is extraordinarily rare. Now close your eyes for a moment, not literally but imaginatively. Picture the version of yourself that exists 10 years from now if you begin applying these principles today. Not perfectly, not heroically, just consistently. That version of you has spent a decade reading, studying businesses, understanding value, building a portfolio of assets not on the basis of excitement, but on the basis of genuine knowledge and conviction. That version of you has sat through market downturns without panic because they understood that price and value are not the same thing, and that time was always working in their favor. That version of you has declined dozens of conversations that began with the words, "I have a great tip." They have not chased trends. They have not been seduced by financial media that profits from their anxiety. They have lived modestly not because they lacked ambition, but because they understood the difference between the appearance of wealth and the reality of it. And now, 10 years later, they are watching something that used to feel abstract become concrete and visible. The portfolio that looked small and insignificant in the early years is producing returns that feel disproportionate to the effort being applied, because the effort was applied earlier, and time has been quietly, relentlessly doing its work ever since. That person is not extraordinary. They are simply disciplined in a world that has decided discipline is too slow and too boring to deserve attention. Their financial anxiety has diminished. Not disappeared, but diminished, because they know why they own what they own. They know what it is worth. They know that the volatility they observe on a screen is not a reflection of the underlying value of what they have built. They sleep differently. They make decisions differently. They relate to their own future differently. And none of this happened through a single dramatic decision. It happened through 1,000 small, quiet choices made consistently over time in the direction of patience rather than panic. This is what compounding does to a life. And it is available to anyone willing to begin Here is what this video asks of you: not to sell your home, not to quit your career, not to find the perfect stock or the perfect moment to begin. It asks you to shift the lens, to begin seeing money not as a reward for today's labor, but as a resource that, if treated with intelligence and patience, can generate a life beyond the limits of what your labor alone can produce. It asks you to take the emotional urgency out of your financial decisions and replace it with something slower, quieter, and ultimately far more powerful. Understanding, because the great investors of history, the ones who built wealth that outlasted them and compounded beyond what anyone thought possible, were not smarter than everyone else in the conventional sense. They simply thought more clearly, more patiently, and more independently than the crowd around them. They understood that the crowd is almost always wrong at the extreme. That what feels obvious in the moment is often exactly the wrong thing to do. That the boring, unglamorous, deeply unsexy practice of buying quality assets at fair prices and holding them for a very long time is one of the most reliable paths to financial freedom that has ever existed. This is not the content that gets shared for its excitement. It does not promise you anything by Tuesday. It does not tell you that you are one trade away from a new life. It tells you something, gee, harder, something that requires more of you. It tells you that the path is long, that the early years will test your resolve, that there will be moments when everything you believe about this process will seem wrong and the people ignoring it will seem to be winning. Hold, study, wait. Not because nothing can go wrong, everything can go wrong, but because the alternative, reacting emotionally to a complex and uncertain world, is a strategy that has never, in the long history of financial markets, produced the outcomes people hoped it would. The secret most employees will never hear is not a number. It is not a ticker symbol. It is not a formula hidden in a spreadsheet. It is this: the person who builds lasting wealth is the person who has learned to be patient in a world addicted to urgency, rational in a world driven by emotion, and committed to a process whose rewards are invisible for most of the journey. That person can be you. If this video gave you a different way of thinking about your financial life, then it served its purpose. Subscribe if you want more conversations like this one. Not louder, not faster, just deeper. Because depth is where the real answers live, and the world needs more people willing to go there.